Rahul Chadha is founder and chief investment officer at Shikhara Investment. Rahul, great to have you with us here. Good morning. Thank you very much for joining us. Prashant this side. Now, the Nifty is already down about 10-11% from its all-time highs. Where does it leave us in this sort of very tough kind of macro backdrop at this point in time? How much more downside if we can kind of start there and then we can get into it?
Yeah. So Prashant, if you look at markets have a habit of overshooting, which was happening in September, and almost everybody gave up on correction. We heard the statements like it's a melt up, valuations don't matter. And now we see things happening on the other side, which is kind of they're undershooting in terms of a valuation perspective. If you talk about Nifty correction from the highs, but if you look in dollar terms, we've had another 5 to 7% rupee depreciation. So the markets for the strong structural story India is in dollar terms effectively 17-18% cheaper. I think first quarter is going to be choppy. First is what we're talking about, the rate cuts getting pushed out, and they got pushed out because of the non-farm payrolls, which were a high number. We would take these payrolls with a pinch of salt. We've seen huge amount of revisions which come with a 2-3 month lag to the payrolls. Bulk of the hiring over last 15 to 18 months has been government and healthcare and hospitality sector. So I'm not sure how much would that continue. And somewhere dollar strength is a form of tightening. Somewhere these high rates are going to work into the economy in form of a tightening. So our sense is US economic data slows down in the second half of this year. What is spooking the markets at this point of time is the uncertainty from the new administration. What does the new administration have on tariffs? Are they going to kind of renew those tax cuts, which means pressure on FIS? And that's why the bond yields are spiking. But in a way, the spike in bond yields is good because somewhere this provides the guardrails for the new administration not to do anything radical and to be fiscally prudent. So I think I would be slowly buying into the dips. This is what we are going out and telling our investors that, look, next 3 to 6 months give you an opportunity. For India specifically, I think large caps become attractive. And then in due course, after seeing these mid-small caps correct another 15-20%, they come again in the buy zone.
Rahul, on those tariffs which you said are the uncertainty, it's a team made up of largely businessmen, right? Not largely, but it's got Mr. Besant, who's as savvy a market person as any, Donald Trump himself. So while we are hearing a lot of tariffs and fire and fury, at the end of the day, what they do you think it'll be calibrated and it'll be done in a way where, it doesn't really send everything in a spiral? Shouldn't one expect that? What's your sense?
Absolutely. You're absolutely right over this. You look at Scott Bessent as a Treasury Secretary, and you look at Lighthizer is out the administration. He's not got any big serious rules, etc. And at the end of the day, our view is Donald Trump wants to leave a legacy as the second president, and that is strong US growth, inflation, and deficit under check. So, which is where markets are going to be positively surprised by what they see from a tariffs perspective. And look, investors are over-allocated, overexposed to US. EMs are the cheapest they've been to US in the last 30 years. And as some of these things kind of recede, I think incrementally you're going to see flows. And we've seen emerging markets do not require much flows to change things. Basically, these are not very liquid. And in today's world, everybody's on the same side of the trade, which is why your up moves get exacerbated. And same thing happens on down ticks like the way it's happening now.
Fair point, Rahul. But the thing is, when those down moves are happening, it becomes tough just sentimentally, right? It's human psyche. It becomes tough to go in and buy against the tide, which brings me to the larger point of the India market construct that you have at this juncture, because banks or large caps are being slammed with all this FPI selling, so you have to work against that. Locally, there's a narrative of maybe a slowdown. Consumer companies have been talking about it. Earnings have been slow. So here, what is it that you are, asking clients to buy?
Yeah. So from our perspective, look, last couple of months, we've kind of tilted the portfolio towards IT and pharma, healthcare. In fact, the tilt started from June of this year, where we realized, look, the domestic economic sectors domestic cyclicals were a bit expensive. You could see RBI tightening, and that had to have some impact on the growth. A lot of these projects which were completed ahead of the elections will take a while to come back. So you knew, and there was a fair bit of an exuberance. So which is why we were conservatively positioned. That's worked well. You look at these AI spends, they're going mainstreams. Look at the order booking which TCS gave. That gives comfort on that. And IT and pharma benefit from the rupee depreciation. So clearly, those are the overweight sectors. At the same time, you believe in the India story. So clearly, what one wanted was slightly better entry points, better valuations. We've seen a bit of a growth slowdown come because government's been more fiscally prudent in India, but it's a small cyclical correction, and I think things get better in terms of a growth improving in the coming quarters. So on dips, one would be looking to add consumption space, one would be looking to add domestic cyclicals, etc. And then there are a lot of quality small mid caps. So I think they become attractive. Look, a lot of these stocks went up 3 to 5 times, and it's not fair, much as what we all fund managers talk about. The stocks never really move in a linear way. It's not that every year they'll come and give you 12-13% returns. They move in spurts. And after a strong spurt, which we saw post-COVID, it is but natural for some of these names to correct, particularly small mid-caps to correct 30-40%.
All right. Hi, Rahul. Good morning. Good to see you in. This is Nigel on this side. Rahul, what about this FI selling? You know, you're talking about believing in the domestic story. Well, the domestic flows are believing in the domestic story. The problem is the FIs. They have been selling, non-stop. December, start of January as well. Do you think at some point of time now, given the entire backdrop for India as a structural story, do you think that should cool off? Point number one. And as you said, the Nifty has corrected around 16% in dollar terms. How much more downside do you think? Another 4-5%, and then it comes to that level where people would like to jump in?
Yeah. So I think our view is somewhere around mid of this year, you would see our end allocators warming up to increasing EMs and India exposure. So that is bound to come. These guys were happily kind of exposed to or versed in the global equities, largely the US equities. But deep inside, everybody realizes that valuations are not cheap. If you look at the large cap names in US, nearly $3 trillion market cap, trading at 25-30 times, it's hard for names to compound at those levels of market caps at that high rates, basically. So which is where EMs become attractive. The reason why we've not seen allocations in last 6 months is from September onwards, there was the sense that Trump administration is going to get voted back to power. You look at the election rhetoric, that was fairly severe. Since the administration's won, which was the results were out in November, things been positive. And you look at the various team members, the various positions which have been given, those are given, as we discussed in this interview, to businessmen, not to ideologists. So I think as the worst case fears don't play out and people realize that there is reasonable growth in emerging markets, particularly markets like India, the fiscal situation is much better. The debt to GDP is much better. I think that's where you should see the outflows turn to inflows.
Rahul, the budget is 3 weeks away. Let me say at the outset, you can't say it doesn't matter. So 30 seconds. Should we expect anything?
I think what happens is with this pressure which is on markets, the worst of the fears don't play out in the budget. The budget may be a market-friendly kind of a budget. We see governments world over, they take a cue from markets in terms of how well the economy is doing. So some correction ahead of the budget is good in terms of market-friendly measures in the budget.
You know, the market always has a mind of its own. Rahul, thanks very much for that. But I was just remembering, it was the July budget, right, when they raised the capital gains tax. The market had its different mood, different mind. Market went up that day, I remember. Despite the rise in taxation and all the tax changes that happened, this time, market has its own mood. We don't know.
Absolutely. And, the only thing is, will they wait to roll out some sort of help for the market? Market-friendly is what Rahul said, right? But the global scene is kind of adversarial. So will they kind of wait to, essentially let monetary side pick up the slack first and then do fiscal? It's a sequencing thing, but there are expectations growing from at least equity investors that maybe something will come, maybe some help for the lower end of the segment, because consumption here has been weak. The global stuff is new. Consumption has been weak for the last many quarters now.